Morning, everybody. It's Max. How's everyone doing this morning? Well, market's off a little bit, isn't it? Yeah. Let's look. We'll start with Defiance, and then we'll look at Yield Max, and then some of the other ones. All right. All right, so Triple QY, we'll start here on the spreadsheet. Go to the bottom row. They sold 128 options for 127 bucks. Look how much premium they received for these options. Look, the last time they received 127 bucks was never, I don't think. I mean, no, they may have a once or twice back here. Back on May 15th, they made 115, or they received they received $131. And they made money that day. The fund ended up making 1.7 million, and they received $158 this day, right here, May 23rd, and the market actually squeaked out a gain that day. So sometimes it does pay that much. Usually it means there's a big economic number coming out. We saw the big economic number this morning. I think it came out at 9, or it would be 10 o'clock New York time, 9 o'clock my time. In any event, it knocked the market down. So we shall see what develops out of that. But if we want to look at from a profit box standpoint, the profit box was gigantic. Look how tall the profit box was, because, that's the 128 points. That's how tall it is how much they sell the option for. Well, that's just because that big number is coming out and the market makers price more risk into the market. Let's look JEPY. They trade SPX options. The chart looks the same. All right, now here's the thing that's interesting. Let's look at IWMY. These guys trade Russell options. What? WTF? Are you serious? And they received extra premium also. Look how much taller their profit box is compared to their past couple of days. Look how much taller it is compared to this day. This day down here was just, some of these, the volatility is getting so compressed. My estimates on IWMY are looking like Russell may just pay like, oh my gosh, tiny amount. They usually always pay more than $1. My estimate's running 61 cents now. So volatility is definitely getting compressed. This little one-day volatility event will help pump the extrinsic back up, and will help pump pump everything back up. All right, so let's go to JEPY. So JEPY, they sold options for $23. And right now they're behind $650,000, but they're still up 14 cents a share on the month. Dividend estimate is a paltry 42 cents, though. On Triple QY, the dividend estimate was 65 cents, and Triple QY was up 15 cents a share on the month. And that's still even after today's gigantic loss. Triple QY is showing a $3.7 million loss right now. JEPY is showing a $650,000 loss right now. It's a smaller fund, though. All right, so IWMY, though, is the oddball. I always say it's the strongest or the weakest. Well, today is the strongest. Most days it's the weakest, to be honest. I usually just say that because I'm trying to put a positive spin on it. But in any event, so these guys are up 20 cents a share on the month on earnings per share, and their dividend estimates, we've talked about, is a paltry 61 cents. Okay, so USOI. So I stayed up till 2 last night, 250 or something. I know it doesn't look like it, but I added a new column where it has the date of entry, and then I added some new a new formula to the closed current price to figure the extrinsic premium more accurately. All right. Now, the dividend estimate's still at $1, even after I made sure everything was fair. One of the things, I double counted one day. I took that out, and when I just checked all the math, and I made a new formula. I think this is way closer than the 250 or whatever it was saying yesterday. So I'll stay on top of this. The problem was they were doing multiple strikes on different days that expired on different days, and the prior day's close right here where it says prior day's close. The way the old spreadsheet was calculating it was wrong. So anyway, I fixed it. So I'm pretty secure with the dollar. Let's look at, just for fun, let's look at TLT because that's Tress's underlying, just to see if this economic number moved Tress around it or TLT around. It really hasn't. Just for fun, let's check out Tress. Let's see what Tress is doing. Tress had a nice pop, but they just couldn't sustain any type of momentum. So, but this is a long volatility fund. So this kind of fund would be going up when the market's going down, most likely, in my opinion. Although this is long volatility on the bond market, but still. All right, so let's go to the Yield Max funds. I'm going to zoom back in here to the 30-minute time frame. Boy, they almost got this strike price. Look at Tesla. They almost got Tesla's strike price. Tesla rolled out to the 275s for next week, for the 19th. So what is that? 6 days from today, something like that. The inverse strike prices are still the same. These are just going to expire worthless like they do every week. Every week they sell these puts and it's all income. It just that put expired worthless. That put. They're all expiring worthless. Okay, so there's two components of a covered call trade or a covered put trade. Well, this is a covered put trade, so there's two components. There's the short put strategy. So yeah, that's working great. And then there's the strategy of to be short puts and be a covered puts, you also have to be short stock. Well, the short stock part of the strategy is getting blown up. But you know, the maybe this economic number that's turning the market around, maybe it'll turn Tesla around. You know, anyway, Tesla can get all the way. They can keep going up. The price of Tesla can go up to 275 between now and next week, and Tesla won't be capped out. So, but right now it's going the other way. So we shall see. All right, let's check out AMD. This is for AMD. These guys just have the 182.50s out there that I know of. I think these are closed. The 182.50s are the only ones I know about. In any event, everything's pulling back right now. So none of the call options are going to be, blowing out right now because the whole market's pulling back. There's Amazon. It has 2 call options that expire tomorrow. Market's pulling back. Call options make you money, but the NAV of all these things are going to go down because they follow just the price of the underlying. So, of course, let's look at Coinbase. This is for Coney, which is the yield fund. These guys had higher strikes and they rolled down from 235s and 230s, and they rolled out to next week, but to the 227s. Yeah, 227s for next week. But this stock, Coinbase, is pulling down. Coinbase was at 227 this morning. It's trading at 219 right now. So the market's running the other way. Let's look at Misty is the yield fund. They have a 2-strike ladder. They blew it. They had their strikes blown out this morning, and now they're pulling back. So anyway, that number, the economic number did a number on the market, so to speak. So Crash is actually up more than anything else on my board. Nvidia is down 5% right now. Oh, we forgot to check Nvidia, but yeah. All right. Well, this kind of bailed out any strike prices that were in danger, and I'm thinking of Tesla. Tesla was, because it's just been getting blown out. They are in. They're looking a lot better, of course. All right. So let's see what else is on the agenda. I got a note that my screen cut out yesterday. I'm sorry about that. All right, so oh, you got to be kidding me. You got to be kidding me. You got to be kidding me. Oh, it was under there the whole time. All right, well, let's see what's coming up. All right, so this is a great time to talk about this. How to use options in retirement. There's a new series starting today. It's called How to Use Options in Retirement Seriously. Like, it's supposed to be have two meanings, you know, like seriously and also like seriously. Anyway, but seriously, the reason I'm interested in this is because Jay mentioned this. He said his favorite thing about in the last of the interview, and well, in the panel, he said what he's most excited about is that options are finally being thought of in serious, circles and being used by serious people in retirement situations. So I have a new series today, and so the first episode is going to be called "How to." The subtitle is going to be how to hedge $1 million. So anyway, check that out. That should be out today. And also, let's check out this GME stock. All right, so I started working on this trade last night, and the $1 million hedge trades is the $1 million baby, and they have different expiration dates. But anyway, watch that video. That'll be a really interesting video. The meme trade I want to talk about is because Roaring Kitty's making noise again. So this is a way to play GME, and I put the trade up yesterday and I saved it. So we'll just check in and see how it's doing. But anyway, it's a trade where you sell the 25 put and the 30 call that expires next Friday. But then to hedge it, you buy the 23 put and the 28 call in the week behind it that doesn't expire until July 26th. Okay. It's a nice little trade. It's a little meme stock trade. And it's a way, what it is it gives you exposure to the price of GME. If GME goes up, this trade makes money. If volatility goes up, this trade makes money. Volatility goes up and the price of GME goes up, this trade makes money. And that's what we're expecting in a meme stock. That's what we're playing for. Max risk on this trade is a couple $100. It's a double diagonal spread, and it's easy to enter at any brokerage platform nowadays. I mean, it seems complicated because it has four legs. I always enter it as one trade, and I usually shoot for the middle of the bid and the ask, and I just keep moving it until I get filled. And I usually don't have a problem if the underline's liquid enough. Whenever Roaring Kitty's in GME, the underlines, look at this one, this option we're selling. This is the basis for this strategy, is selling this 30 call for $1. It's ridiculous. It's 5 points out of the money by next week, and it's $1. That's ridiculous. That's what we're monetizing right there. So, but you can see the bid ask is a penny. There's 9,000 contracts. There's 60,000 contracts open. Roaring Kitty's probably in this one. I mean, maybe we sold some contracts to him. Maybe one of these contracts got sold to him. In any event, all these options are liquid. Look at this. This one has a 11 cents, which isn't bad for an individual stock. A dime spread. This one is a 9-cent spread. This one is a 20-cent spread. But in any event, these don't expire till the short legs don't expire till July 19th. So what we're hoping for is volatility to go up, and if volatility goes up, then it makes the break-even price of this go down. Watch this. See, volatility, this trade has exposure. It's long volatility. Anyway, so we either want volatility to pop and we'll make more money, even if price doesn't go anywhere, make $50. But if price goes up, which is what we're anticipating, and even if we just hold it till the middle of next week, make a couple $100, and hold it till expiration, and which you probably wouldn't. If we pen the strike, if we get that 30 strike, it's $355. We'll probably hold it till right around in here until we get most of the meat out of the trade and then roll out to another one. Anyway, that's a nice little trade. I'll post the link in the comments if anyone's interested, but we're just going to follow that trade we'll just follow it in the morning, see how it's doing in this update. Okay, so I hope you guys could all see that. I hope I'm doing this right. All right, so we had a pre-earnings play on Tesla we were going to look at also, and I talked about this on the show yesterday, but I don't know if that show ever aired. I had a show that I never did air that I talked about some stuff on. So let's go back over here to Option Land. Tesla pre-earnings double diagonal. This is the same type of trade. Exactly the same trade. We're selling a put in a call, which is a strangle, selling a strangle in 1 week, and then buying a strangle in the week behind that. Short 2 options, long 2 options, short a call, long a call, short a put, long a put. Very easy trade, very easy type trade. It's a arbitrage, you could call it, or it's that type of trade because it's relying on the relationship between the internal relationships between the two assets to change. More so than just relying on just betting on a one-way directional price change, either up or down in the market. It's a little bit deeper idea than that. Well, anyway, on this Tesla trade, this one, and I'll post a link to this one also. This one's about $700 risk, and we're coming up on Tesla's earnings. They have earnings on the 23rd, so I'm saying going into earnings. Here's the Monday of earnings. 11 days from now, people are going to start talking about, will be talking about Tesla. Who knows where the price will be, but I think between now and then, volatility will probably pop because people will be preparing for the earnings and will be YOLOing. A lot of people retail buys options and stuff prior to earnings, so we're trying to find an options to sell them. So anyway, and then we're hoping that right before their earnings are the 23rd. So on the 22nd, right here, wherever we're at, we're going to take it off. Wherever we're at, we're going to take it off because after earnings, volatility collapses. This trade is long volatility. After earnings, volatility will go back like that. So this is just a pre-earnings trade, and we want either the price of Tesla to keep going up. If it does keep going up, we'll make about $350 on about $700 risk for 2 weeks. That's not bad. Not 50% in bad return for 2 weeks. If it stays where it is, that's the real power in this because we're monetizing all this time decay. All right. So let's go back to the sheet. Last thing we're going to look at is QQQY versus QDTE. This was a subscriber question. So what I wanted to do is do it like this. I never look at the top window because that's reinvesting dividends. Even though that's a good thing to do, some people don't do that, and it makes the comparisons, in my opinion, not clean. So a clean comparison on this, yes, QDTE is 2 points ahead on total return, and that is the truth serum. So what happens with all the other stuff doesn't really matter to me. The QDT has been having a nice run here. Now let's see, but still doesn't mean that a person may not want triple QI for a variety of reasons, but these are right neck and neck. So let me make the case for triple QI. So the case for triple QY is, for one thing, look when the market pulled back in April. QDTE was down pretty much as the market was down. QDTE does great when the market's going up, okay? But because it sells an option that's not even a 24-hour option. It's like a 7 or 8 hour option. They don't receive as much premium. There's a trade-off, though. They're uncapped at nighttime, so they participate in some of the 24-hour moves of the market. So it all involves the path. It involves path dependency. To figure out which strategy is better, you have to know how the market's going to. You have to be able to predict the future. So I'm not saying the QDT strategy is better or worse. I'm not trying to make a qualitative judgment or a quantitative judgment. But I will say this, if you want dividends, if you're trying to retire on dividends, they've both paid. The good news is they've paid, QDT's paid $4 and triple QY's paid $3 over the same time period, basically. Okay. The thing is, triple QY's price is 3 times as much. So they ought to pay, instead of $3 like QQQY paid, if it was even, they ought to pay $8 or $9. So they're paying about half the dividend, and that's because they're catching less time decay. That doesn't surprise us. Well, the time decay is the buffer. The dividend and the big dividend or whatever, that is the buffer. So the thing is, when you're making less buffer, when you have a down market, you're going to realize a lot more. You're going to have less buffer, so you'll realize more of the downside. You can see here, people just don't realize, and probably will never realize until we get a down market, that the triple QY and JPY, the full overwrite daily ones, are actually the safest funds in a down market, believe it or not. I know no one believes it. In any event, you could see it right here. Somebody that had QDTE may have got a margin call in April, where somebody that had triple QI wouldn't have. But let's say you were, right up to the margin limit, you know what I'm saying? That could make a big difference. So to me, triple QI is a better all-around play, because I'm more worried about the downside. To me, the best all-around play is QQQT, but that one's brand new, and it wouldn't be fair to compare that to QDTE. But I bet that would be when triple QT is a couple months old. We'll compare it to QDTE. In my opinion, that'd be more of a fair comparison. But like I say, I'm not saying QDT is bad or good. It's good when the market's going up and less good when the market's going down. Triple QI, I'm not saying if it's bad or good. It's less good when the market's going up and a little more good compared to QDT when the market's going down. So in any event, I just wanted to look at those real quick. I'm glad I've managed to get those on the screen. All right, guys. So let me see. I'm going to figure out how to do this. All right. It's not that hard. I just need to practice. All right. I'll be back later. But yes, be watching for my new video. I'm getting ready to shoot it right now. I hope you guys will like it. All right. See you later.